Welcome to Talk Tickers. Today, we're diving into one of the biggest accounting shakeups in recent memory, lease capitalization. Now, if you're an analyst, figuring out how these new rules can totally warp the financial ratios you depend on, well, it isn't just important, it's absolutely critical if you want to get your valuation right. For decades, a company's true debt was often hidden. These massive lease obligations, which are basically a form of debt, were just buried in the footnotes. It forced analysts to play this guessing game. But as the ISAB chairman put it, that whole era of lurking debt is finally over. The shadows are gone. All right, so here's our game plan. We're going to start with why this was such a problem in the first place, this hidden debt. Then we'll look at the old rules versus the new ones, see how the balance sheet got a major facelift. And then, this is the big one, we'll dig into how this messes with all our favorite ratios. We'll wrap it all up with what you absolutely need to know and the one question you should always ask. So, what was this big issue that made the accounting world decide on such a massive overhaul? Well, it all boils down to two words: off-balance sheet financing. See, under the old system, almost everything was called an operating lease. And what that meant was companies treated it just like paying rent. It was an expense, sure, but it never ever showed up on the balance sheet as an asset or, more importantly, a liability. We analysts knew this wasn't the full picture, so we had to invent these workarounds, these rules of thumb, like taking the annual rent and multiplying it by 6 or 8 to guess the hidden debt. It was an educated guess, yeah, but it was still a guess. So the new standards, that's IFRS 16 and ASC 842, they represent this huge shift away from all that guesswork. It's all about transparency now. Let's get into exactly what changed. The old definition was all hung up on this vague idea of transferring the risks and rewards of ownership. If a lease didn't meet some really specific criteria, poof, it was an operating lease. This created this bizarre all-or-nothing situation where two companies could have almost identical lease agreements, but they'd look completely different on paper, totally obscuring who had more leverage. Okay, this table really tells the story. Look at the before column. On the balance sheet, nothing, zip. Now look at after. Bam, we've got a right-of-use asset and a lease liability. On the income statement, what used to be a single lease expense is now split into depreciation and interest. And this is huge for EBITDA, right? It automatically looks higher because that old lease expense is now gone. And even the cash flow statement gets rearranged. What was a simple operating outflow is now carved up into financing and operating cash flows. It changes everything. So yeah, the most dramatic change is right there on the balance sheet. Let's take a closer look at how these once invisible obligations are finally brought into the light. This flowchart is just a perfect way to see the new logic. Let's walk through it. It all starts with one question. Is there an identified asset? If the answer is yes, it keeps going. Does the customer get the economic benefits? And, this is the real key, does the customer have the right to direct how the asset is used? If you're saying yes, then guess what? That contract has a lease. It's a total switch from caring about legal ownership to focusing on who's actually in control. So the bottom line is this. Unless it's a really short-term lease, pretty much every lease contract now creates a right-of-use asset and a lease liability right on the balance sheet. And man, this has blown up the reported assets and liabilities for companies in industries like retail, airlines, telecoms. Their balance sheets looked completely different practically overnight. And here we are, the heart of the issue for every analyst out there. Because while these new rules give us transparency, they also create what I can only call an analytical mess. I like to think of it this way. The new rules don't change the company's actual health, but they completely change the X-ray. Our job is to learn how to read this new image. The very first thing you need to burn into your brain is that any improvement you see in metrics like operating profit or EBITDA is purely an accounting trick. It's a reclassification. It is not a sign that the business is suddenly more profitable or generating more cash. Let's be super clear on how this works. That old operating leased expense, the one that used to be a normal operating cost and reduce EBITDA, it's gone. It's been replaced by interest expense and depreciation. And by definition, what do we do with interest and depreciation when we calculate EBITDA? We add them back. So the result is this purely artificial jump in reported EBITDA, which has massive knock-on effects for everything from valuation multiples to debt covenants. And to make our lives just a little more fun, IFRS and US GAAP decided to take slightly different roads. Under IFRS, all leases are treated pretty much the same, which leads to higher expenses in the early years of a lease. But US GAAP, it kept the old operating and finance lease labels. Now, both go on the balance sheet, but for an operating lease under GAAP, the expense on the income statement is still a single straight line. So an IFRS company and a US GAAP company with the exact same lease will report different net income. It's a huge headache for comparing companies across the globe.
Now let's use a classic tool like the DuPont analysis to really see the ripple effect. First, asset turnover. That's sales divided by assets. Well, because that new right-of-use asset makes the assets number bigger, the whole ratio goes down. It makes the company look less efficient. At the exact same time, financial leverage, assets over equity, goes up for the very same reason. So you might end up with a similar return on equity, but the drivers behind that number have been completely twisted.
Okay, so how do we actually deal with all this in our day-to-day work? Let's boil it down to the key things you have to remember. First, just accept that comparability has taken a major hit. You can't just compare a company's 2020 ratios to its 2018 ratios and call it a day. Second, the footnotes are now your best friend. You have to live in those disclosures because that's where management hides, or rather discloses, their key assumptions. Third, watch out for frozen discount rates. The rate used to value the lease liability is set once and never changed, so you might need to adjust it yourself to figure out its real economic value today. And finally, you have to know how the company adopted the rules because many didn't restate past years, which just shatters any historical trend analysis. Look, when you're staring at a company's financial statements under these new rules, it can feel a little overwhelming. So to cut through all of that complexity, here's the one single question you should always have ready. What are the key assumptions, the discount rate, the lease term, and any variable payments that were used to calculate the lease liability? And why does that matter so much? Because at the end of the day, it's these judgments made by management, not just the accounting rules themselves, that decide just how big that debt on the balance sheet is going to be. So that's our look at the new world of lease accounting. As always, just a reminder that this explainer is for informational purposes only and is not financial advice.